another episode of Palisade Radio. I'm your host, Karim Mutlu, and today we're coming live from Jekyll Island at the 2019 Palisade Hard Asset Conference. With me today, I've got Matt Geiger, who's the managing partner at MJG Capital. Welcome back to the show, Matt.
Thanks, Karim. It's great to be here in person with you and back at Jekyll as well. I think this is the third Palisade conference at this point that I've had the opportunity to speak at. And it's great. It's always worth my time. The conference is getting bigger and more star-studded every year, and it's great to be here.
Let's begin by talking about being a contrarian. Is being a contrarian something that you can actually learn, and is it a skill set that you can actually get better at over time? What is your experience, Matt?
So I don't want to be a downer here, but I do feel that in terms of being a contrarian, a lot of it is personality and intuition. And for whatever reason, I've always been the way where if everybody's doing something, if everybody's excited about something, to me that creates caution and almost concern. And I like things that are kind of counter trend, if anything, or people are apathetic to be honest. So, I think Buffett said something similar, and this is about value investing and not about being a contrarian exactly. But he said, in terms of buying $1 for 50 cents, some people get it and some people don't. And to me, in terms of being a contrarian and kind of a deep value investor, it just kind of clicked. It just did make sense. But I do think it is smart, whether you're choosing investments or where you're going to work in the future and professions and what have you. Go to industries that aren't overcrowded. Go to the places where people aren't extremely excited about now. And I think that serves you well in life beyond just picking good investments.
Some very good advice there. Okay, let's turn on to the battery metal space. I want to know what your current thoughts are on nickel, cobalt, and lithium. And let's begin with nickel. Where are we today?
Sure. So it's been a tough run for battery metals, as probably many of your listeners know. Really since late 2017, maybe early 2018, we've seen the equities across the board, whether we're talking lithium, cobalt, or nickel, fall pretty dramatically. Of the three metals you mentioned, nickel is by far the one that I'm most excited about. And your listeners may have heard the news recently that Tesla made a presentation at the Benchmark conference in DC, I think just within the past 2 weeks. And this was a bit of a surprise. Tesla is very, very tight-lipped. They like to keep their cards close to their chest, especially in terms of kind of material supply and the battery metals and what have you. But at this conference, they sounded the alarm and said that they believe there's going to be severe shortages of these battery metals in the years to come. And they're worried about it in terms of their business model and profitability. Elon Musk is on the record already saying that these batteries should really be called, instead of lithium-ion batteries, nickel-ion batteries. And I think he's right on the money there. As some of your listeners may know, just a few years ago, kind of the prevailing cathode chemistry, and we'll just look at nickel, manganese, cobalt cathodes, was roughly a third nickel, a third manganese, and a third cobalt. Nowadays, that's shifted pretty dramatically, and the prevailing chemistry out there is 6 parts nickel, 2 parts cobalt, and 2 parts manganese. We already have groups out there that are producing, and many more are working on R&D right now to make this disparity even more extreme, going to maybe 8 parts nickel, 1 part cobalt, 1 part manganese, or even more aggressive, 9 parts nickel, 1 part cobalt, 1 part manganese. So I think that's clearly where we're trending. I think nickel is a clear beneficiary. And I think the reason the battery manufacturers and EV makers are doing this, there's 2 main reasons. The first is price. Cobalt is significantly more expensive than nickel on a per pound basis. And it's also far more volatile, as we've witnessed over the past few years. We're seeing cobalt shoot from the single digits, up to the mid 40s, and then come close to all the way back at this point. So there's a lot more volatility there. And the second reason is more out of security of supply concerns. So, at the moment, roughly 60% of global cobalt production comes from the Democratic Republic of Congo, and that's just due to a pretty incredible mineral endowment they have there in terms of cobalt. And I really think these battery makers and EV manufacturers and what have you don't want their company's future to hinge on political stability in the DRC. And that makes a lot of sense to me. So this shift is happening. It's going to continue. Nickel will be a big beneficiary. I'm still a fan of cobalt. I don't think it's going to be possible to fully remove cobalt from battery chemistry because it helps with stability and to avoid overheating. So I'm of the opinion that cobalt is still a good investment as well. But if I had to pick one of these horses, it would be nickel for sure.
Last time we talked about the insider ownership of resource companies. So let's talk about how you discover the next generation of company builders and teams. What do you look for?
So let's start with the management ownership aspect. This is absolutely essential in this space. The space is about people. Projects are important, but generally good people attract good projects. That's just how it works. Apple or Google, and I've given this example before, they could get away with a mediocre CEO for 3 or 4 years without a significant hit to business. They're going to be fine. But for these junior companies, and there's a few other industries like this, biotech and Silicon Valley technology companies, you're making life or death decisions on a day-to-day basis in terms of the company. You need people that are smart, that have done it before, that have access to capital, well-connected, have skin in the game, so they're incentivized to make decisions that jive with you as a shareholder. So to me, it's all about management ownership. It also protects against some of the ills that plague us in the junior space in terms of excessive G&A spending, maybe unwise project expenditures, or continuing to chase something out of project that really should be killed. Unwise acquisitions as people try to empire build and build their market cap with no regard for creating value on a per share basis, and again, so many other issues are solved by this. So whether it's a young management team, an old management team, I'm always looking to see that they have skin in the game. And if it's a junior company with a sub $100 million market cap, I really do want to see that management ownership percentage in the double digits. Now, in terms of betting on the next generation of management, generally I try not to. I'm willing to make exceptions, but for me, I would rather miss out on that big success from a new mining entrepreneur than bet on 10 of them and risk that it all falls through. So for me, I'd rather back the teams that have had past success. And if you get into their next deal and their next deal, you're not going to be able to get in at the same price, at the same valuation. But to me, it's worth it. You just bet on the people that have made money before for investors. It's not too complicated. There are some potential exceptions, but I really need a referral. Well, more than a referral, I need somebody that I really trust who's made money in the space for me before to put money behind one of these next generation entrepreneurs. And in those cases, that can be an exception where I put some money to work. So, example of that, and this is not a recommendation, we all have our own, risk tolerances and what have you, but Victory Metals is a holding of ours. And as you know, Colin is a relatively new CEO in the space. He has a lot of experience in the junior mining industry, of course. But to me, it's the backers that he's gotten behind Victory Metals that really gave me the confidence to write that check. So, generally, as a rule of practice, I'm not out there looking for the next big resource entrepreneur. I want to back the teams that have made money before. In rare circumstances, if somebody I really trust is willing to back a team and put their own check into the company, then I'll take a look.
Very good. Okay, as we begin to wrap up the show today, Matt, is there anything else you'd like to talk about? I know you're going to give your keynote speech in about an hour's time, so what can you share with us with that?
Absolutely. So I'm looking forward to this. I'm just going to take a step back here. We've gone through really 8 years of unabated pain. There, of course, were some good months in 2016 and then for parts of 2017 as well. But I'm going to take a step back here and talk, why I think those of us, at this conference with a large percentage of our net worth in natural resource equities are poised to do very, very well in the years ahead. And there's really 4 planks to this argument that I'll be talking about. The first is favorable population and consumption trends over at least the next 30 years. Even taking extremely, extremely conservative birth rate forecasts, we're going to see global population continue its ascent through at least 2050. And consumption on a per person basis, in my opinion, is going to continue to grow exponentially until real price rises in the price of commodities and metals and other resources force human behavioral change. So that's kind of the first plank of my argument. The second is that if you look at the long-term performance of miners versus holding the underlying physical metals, and a good kind of anecdote for this, so if you look at the prices of industrial metals over the past 90 years, aluminum is down 1.7% in real terms. Iron ore is down 0.2% in real terms. Zinc and lead is down 0.1% in real terms. Only copper is up over that period, and it's only up by 0.2% in real terms. But if you were to buy the mining equities that mine these metals, so the diversified miners, over that period, they're up roughly 8.5%. So that's a dramatic, dramatic difference. And to me, that what I call the equity risk premium is so extreme that if you're investing for any reasonable duration of time, it's best to focus on the equities and not buy the physical metals. Kind of the third point I'll focus on is that, to the surprise of many, the long-term performance of resource equities when compared to equities generally is very favorable. If you look at the S&P 500 and you compare the performance of the index relative to the material and energy companies in that index, for the past 90 years, the resource extractive companies in the S&P have outperformed the S&P by a 2.2% margin, which is significant. Now, it must be stated that I'm talking about bigger companies here and not the junior space. I'm not advising by any means for you guys to go out there and buy a basket. Juniors need to be handpicked, and you need to be just incredibly selective. But I think the point still stands that resource equities do belong in investors' portfolios. And of course, when the bigger boys, the Glencores and Techs and BHPs and Rios of the world do well, which I expect them to do in the years ahead, you do see the trickle-down effect into the juniors. So we're all kind of on the same team. And then finally, quickly here, the fourth point I'll be talking about is that we're historically cheap relative to most every other asset class. And depending on what metric you're looking at, whether it's the GSCI relative to the S&P, we're at 30-year lows. If you look at real assets generally versus, what we call financial assets, we're at, 90-plus year lows. So to me, the timing is right. And, since 2016, we've kind of bounced along a bottom here. So I don't think, by jumping into the space right now, there's less of a risk of you, trying to catch a falling knife. So, I think the timing is also right, in addition to the above reasons I just went through. So I'm excited for the space and look forward to sharing my thoughts with the conference.
Okay, well, thank you very much for sharing your time with us here at the conference today, Matt. Much appreciated.
It's great to be here with you in person, Karam. Thank you.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?